Welcome to VRIC Media, the most trusted voice in junior mining. Now, my guest today is the infamous Ed Dowd, who is the founding partner of Phinance Technologies, and prior to that, has a lengthy and storied career on Wall Street with firms like HSBC and BlackRock and many, many more. And if you remember, in 2021 and 2022, he became a very controversial figure for a book that he published. Now, I had to get Ed's take on the new American administration, where he thought things would likely change and where they were likely to remain the same. And I found his perspective and his context to be invaluable. So this is a fantastic interview, and I know you're going to love it. Right before we jump in, real quick, I'm hosting my annual conference on January 19th and 20th in Vancouver, British Columbia. This is the Vancouver Resource Investment Conference. We fly in about 110 keynote speakers from all over the world, individuals like Robert Kiyosaki, Danielle DiMartino Booth, Grant Williams, Brent Johnson. We've had former Prime Minister Stephen Harper, former President Felipe Calderon, many, many more. It's a blockbuster event, about 350 investment opportunities in the junior mining sector, and typically about 7,000 investors. So www.cambridgehouse.com for tickets to the Vancouver Resource Investment Conference. But way more importantly, here is Ed Dowd. Enjoy.
All right, we're going to get rolling.
They helped create an economy that was completely addicted to cheap money.
You need to buy savings bonds or something. You need to be way, way, way out of this space.
I subscribe to Miss Piggy's rule of money management. Always manage to have more money, you know what I mean?
It wasn't but 2 years ago that everybody was saying China's economy was going to be bigger than that of the United States. It's gone in the exact opposite direction.
So we're going to jump right in.
Okay, here I am with Ed Dowd. Ed, it's great to have you on the program. Thanks for making the time.
Jay, thanks for having me on. Great to be here.
Okay, so my first question, there's a handful of directions that I want to go today, but here's where we'll start. We just wrapped up a fairly contentious election, dominated the headlines for the last year. We're on the other side of that now. Do you think we've experienced or will experience a major paradigm shift? Like, is this consequential? Look at it from a market standpoint. Markets are ripping after the election. Is this a short-term reactionary activity, or is it a symptom of something larger? What's your take, Ed? And then I'll just pull on some threads from there.
Well, we have to go back to 2023. Our firm was predicting a recession in the second half of 23, never came to fruition. And there were a couple things done. If you remember, we had bank failures, Silicon Valley Bank, and things were getting ugly quick. And the Federal Reserve came in and did the bank term funding program and kind of put a plug in the dike for the time being. And then going into an election year, the government ramped up its spending, the likes of which we've never seen. And then we saw fraudulent payroll numbers, most of 24. And the GDP numbers they put up don't foot with what we're seeing economically in all the indicators. Not just our quantitative indicators, but, mainstream economists are seeing some alarming signs. So I'm optimistic. Look, if Harris had got in there, I was going to be very unoptimistic. I'm less concerned about a downturn. It's coming. The question is, can Trump and his policies and the animal spirits that he's going to release, can it mitigate the economic turd he's inheriting? So that remains to be seen. Unfortunately, what I'm seeing in the equity markets is a speculative bubble, and the makeup of this happened in 2000 and the 07 top. We had kind of a natural top where all stocks participated. Then we had a correction. Now we have a rally that's really dominated by a couple names, and the average stock in the S&P 500 has not gotten back to even the 2022 highs. So for now I look like a fool, but when this does happen, it's going to be pretty devastating. We got some signposts. Commodity prices peaked in 22. They haven't gone up in response to this equity rally. We have interest rates. The Fed just cut again last week. And my friend Tim Wood, cyclesman.com, he's done some analysis, and he said these are the two most aggressive rate cuts since 1957. That's how far the data goes back. And what we mean by that is usually the 3-month T-bill anticipates Fed rate cuts. This is kind of a little known fact. The market kind of leads the Fed. And the spread had traditionally been like 120 to 150 basis points pre-2009. And the spread's been getting narrower, but the last 2 cuts were under 100 basis points. We had a 70 basis point spread in the September cut, and we had 50 basis point spread in the most recent cut. So the question you have to ask is why? It's the $1 trillion question. They're the most aggressive. They normally don't cut this fast. So you could say they were trying to help the Harris administration being political, or things behind the scenes, the plumbing in the system is bad. And what do we know is going on in Japan? Japan has a Hobbesian choice to make. They need to either defend their currency or be blamed for the yen carry trade unwinding, which started to unwind in August, but then they did some interventions. So we are seeing kind of the beginnings of the crack in the global financial system, where, basically the decision was made after 2009 to fix a debt problem with more debt. And, if you look at what gold has been doing, gold has been rallying in anticipation of this coming disaster. Gold, I think, unfortunately, if we do have a financial margin call where everything starts to go down in response to the real numbers, gold will get hit, but I don't think it will get hit as bad as it did in the 2008 crisis. Gold went down 50%. I think gold has a better chance of only going down 25% and then going to new all-time highs, after the correction. So gold, we like gold long term. But look, this correction that's coming in the equity markets, the real economy is already in the tank. And, if you want to know why Trump was really elected, there was some interesting stats I saw from an economist friend of mine that he keeps his stuff private, but he allowed me to talk about it. It was minus 2% real wage growth going into this election. The last time that happened in 1980, Ronald Reagan won in a landslide. In 1992, when Bill Clinton won the election, there were three candidates at the time, but Bill Clinton won, and it was the economy stupid, as James Carville said all the time back then. So I was on a couple shows being asked, who do you think's won or going to win? I said, Trump's already won, according to this economic indicator. And the question is, is it too big to rig, so to speak? And it turned out to be too big to rig. So the real economy, the average person on the street feels it. Business activity's down, home sales are down. Employment it'll become apparent soon enough that employment is a disaster and going to get worse. So Trump's going to inherit a turd. The question is, can his policies prevent, what I thought was going to be a total wipeout? I hope so.
I want to dig into those a little bit, because I feel like on the campaign trail, things were kept a little bit vague. So, can the Trump animal spirits intervene in such a way that would soften the blow, lessen the likelihood of a deep recession? What do you look towards, Ed?
Well, so he needs to cut regulations. Cutting regulations and red tape would help tremendously and create animal spirits. They're talking about cutting the government, which needs to be done. But that's been the only game in town for the economy. So any, hacking of the government spending is going to affect the economy in the short term. Long term, it's a great thing, but the Band-Aid needs to be ripped off. But government spending has been the only thing really holding this up. And if you looked at the month of September, I think the payroll number was the largest number of government jobs ever created, 750,000 jobs doled out in the month of September. And just putting people on the payroll, giving them makeshift jobs. So, and of course, immigration is a dirty little secret as well. Immigration has helped the economy because you've been handing out goodies to these illegal immigrants. That helped increase the velocity of money. So you had the Fed come in and stop the bank run. You had the unprecedented government spending, hiring, and then you had the illegal immigrants getting basically large amounts of money that they immediately dump into the economy and spend, that increase the velocity of money. Trump is going to go after those things. So I suspect that's going to have an adverse effect on the economy in the short term. The question is, can Trump navigate the downturn, be transparent with the people? We're going to have to take some pain, and then we're going to unleash the animal spirits in the private sector. This doesn't happen overnight. And they handed this to Trump on purpose, I think. I really do.
What do you mean by that, Ed?
Because they've hidden. We're going to come to find out there's fraud in the government numbers, the GDP numbers, the BLS numbers, and the central bank cycle has a fraud element to it. It always ends in fraud. And if you look at the 90s bubble, the .com bubble, that was corporate fraud. And then we had a crash. We had some rules put in place. Then in the 07, 08, 09, there was massive bank fraud. And then the Fed stepped in and the government stepped in. And what did they do? Did they prosecute that fraud? No. There was not one banker that went to jail. And that fraud still resides on the balance sheet of the central banks. All those bad mortgages are still there. And so what ended up happening over the last 14 years was unprecedented government spending and quantitative easing and basically kicking the can down the road. And I suspect, and I already have good evidence of this with the non-farm payroll being revised down 850,000 in August, the fraud just moved on to the government, the governments of the world and the central banks. So I think right now, what does the Fed know that we don't? Warren Buffett is selling his Bank of America stock faster than you can shake a stick. And he's selling it at all-time highs. And he knows, and he's also accumulated the largest cash pile in the history of his outfit. And he owns 4% of the T-bill market, more than the Fed. So I know I sound like a broken record, and people are like, oh, you're missing out on all this good stuff and all these rallies. The problem is it's an escalator up and an elevator down. And when this thing, my fear is when this fraud is revealed, and it would behoove the bureaucracy to reveal the fraud on Trump's watch, and then we see what happens.
So that makes absolute sense and good context. 2000 was sort of defined by corporate fraud, 2008 bank fraud. This correction that inevitably is coming might be defined by government fraud. Is there, as I'm hearing you say this though, Ed, and I totally understand the concept that Trump will have to be the president to come clean on these numbers, could that not also be a massive advantage, given that I think over the last couple of years, a theme coming out of any independent media has been a lack of trust? I mean, here's an interesting stat. This last election, mainstream media kind of told us one thing the entire time. This is a razor close election. Polls told us the same thing. Razor close election, coin toss, too close to call, all this stuff. Independent media was not saying that. And some numbers that I'm putting together a piece right now. YouTube is the biggest podcast platform in the world. It's bigger than Spotify. It's bigger than Apple iTunes. Trump generated 142 million views on YouTube on the various podcasts that he was a guest on. Harris generated 4 million views. So 142 million to 4. Now, that's largely a consequence of Trump doing a lot of independent media and Harris doing very little. But it's, they say that to understand, you can understand a lot about media cycles by looking at election cycles, right? Going back to Nixon and JFK, I think, was the first televised presidential election. And JFK looked like energetic and youthful, and Nixon was kind of tired and sweaty looking. And people say that cost him the election because this was the first time people got to see them in person, debate each other. And that defined the next media cycle as well. All where I'm going with this is, could this not be a boon to the Trump presidency? Could he not come in as the guy who uncovers this fraud and say, look, you knew you couldn't trust these people. We knew something was wrong. And here, I'm going to prove it. Let's look at the jobs numbers. Let's look at et cetera, et cetera. Could this be an advantage in some way?
Absolutely. And once this starts to manifest, I hope to be able to help frame that argument.
Okay.
whether going on podcasts like yours or talking to someone in the administration. They need to grab hold of the frame and be honest with the American people. What's going to happen is the mainstream media will immediately blame Trump. We know this. Yeah. And that and Trump has an opportunity here to really take the frame of the narrative and run with it. But it's going to take proper framing. It's going to take proper understanding. It's going to be beholden upon his advisors to understand when this does come, why it's happening, and that it was set up. The dominoes were set up before he stepped in. And right. So as long as that happens, I think you're right. I think he could take the bull by the horns and come clean with the American people, expose the fraud, not be a victim of it, and pretend that this recession, which has already occurred in the real economy, that will eventually come to the financial markets, lay it at his lap. And that's why he won. He won because the average person is in pain economically. And you can see it, you can feel it, and that's why he won. So I agree with you. Another thing that's interesting you said about those social media stats. During the 2016 election, I had a much smaller following on Twitter back then, now X. I made the same prediction he was going to win because, like you, I was looking at social media, which was newer then, and his views on YouTube were just off the charts compared to Hillary Clinton's. They were even worse than, Kamala got 4 million. Hillary was getting like 5,000 views for like whatever. And so, you can look at the real numbers like that and get an indication by that alone that he was going to win. In addition with the economic data. And, that's part of the matrix we live in. We got these two realities, these two perceptions. The good news is more people are coming around to our perception of reality. The bad news is there's still a lot of people who have no clue what's really going on. And they are brainwashed and propagandized, and they literally live in a different reality than you and I do. And it's dangerous to the nation and to other nations.
Yeah, certainly. Now, I think that this selection was defined by independent media, and one candidate recognized that was the trend and one candidate did not. Probably a big factor in the outcome. Quick break here, guys. Today's episode is brought to you by Coppernico Metals. Now, regular viewers of my channel will be familiar with the entrepreneur behind Coppernico. His name is Ivan Bebek. Now, although a young man in this business, Ivan's already created tremendous value for his shareholders in the past, namely with Caden Resources, which he sold to Agnico Eagle, and Keegan Resources, which became a mine now owned by Galliano Gold. Now, Ivan has surrounded himself with expertise from BHP, Newmont, and VRIC on his board at Coppernico Metals. Check out CoppernicoMetals.com. Now back to the interview. Now, you talked about the efforts that will likely be made to cut back on government, right? In a variety of ways, and maybe Elon Musk is going to be the head of this movement. The government efficiencies are. You talked about how many of the new jobs created were just government jobs, easy way to inflate those numbers. But that also, this is the only game in town. My question for you here is, how easy of a job is that? Because on one hand, you've got a CEO who has shown he can cut the surplus expenditures very quickly, and he can cut very deep. That's what he did with X over the last 2 years. Cutting government jobs is a different thing. No? Or what's your take on how effective, and what else can you cut? Both candidates, they promise tax cuts. They'll probably deliver on those. You can't cut entitlements, military. You can't cut Social Security. What you can cut is government jobs. You can cut the overhead. Is that realistic, though? What's your take?
Well, it has to be done properly, and there needs to be, unfortunately, a consideration for some of these people that are kicked out into the cold streets. I heard Elon float the idea of giving everybody that they fire a 2-year severance, which that would give them economic wherewithal to transition to the private sector. Yeah. And that way there'd be less economic pain. If there is no severance and people are thrown out into the street, it would cause immediate impact on the economy. So there needs to be some consideration for that, as much as people may not like that. I mean, from a populist standpoint, no one wants to see these people get 2-year severance. But if you're gonna transition the economy from an economy where the government has grown considerably since COVID to an economy that's going to foster the private sector, that needs to be done. There needs to be a handoff, and it needs to be as smooth as possible without causing as much economic pain as can be avoided.
Yeah. Yeah. If you're going to rip the Band-Aids off, you might as well do it in the most palatable way possible. And a 2-year severance is, makes you definitely scratch your head a bit. But if that's what gets the job done, maybe that makes sense. Okay. I want to pivot back to, you made some comments on Buffett and him. And last time I heard you was maybe 3 or 4 months ago on Julia DeRose show. And I think you said at that point in time, Buffett owned 3% of the U.S. Treasury market. Today, the number you said was 4%.
Yeah, it became 4 about a month or 2 after I did that. Okay. And why people talk about the death of the dollar? Why would you own T-bills? The dollar is not going to die anytime soon. It's the world's reserve currency. It's backed by our military might, and the dollar is under threat long term. I agree. The BRICS talking about it is not a good thing, but they can't even agree amongst themselves. And there's also 15 to 18 trillion in dollar-denominated debt that sits in these countries. So if they were to de-dollarize themselves immediately, they'd have a deflationary implosion. So it's a process over time. So Warren Buffett has been around a long time. He understands cycles of economics and easing cycles and rate hike cycles. And he knows what's coming, and he knows that there'll be a shock to the system, and he's doing what he does best. He's not calling the top to the day. He started doing this a year ago. And now he's got the biggest pile he's ever had, and he puts it in 3-month T-bills because he looks at this is how he thinks. I'm getting paid 5%, or I think it's 4.75 now. But when he started doing this, it was 5.5. He was getting paid 5.5% to sit and wait for much cheaper prices. And when he's thinking cheaper, he's not thinking about a 10, 15, 20% pullback in equities. He's thinking 50 to 80%. The last 2 drawdowns in the equity markets that have been significant were both 50%. The 08, 09 drawdown and the 2000 drawdown were 50% from high to low in the equity markets. So that's what he's looking for. He's looking for panic and blood in the streets, and he'll do what he did in the great financial crisis, go to these banks and bail them out again.
Do you... it's funny because you just referenced 2 moments in relatively recent history where we saw 50 to 80% drawdowns in the equity market, 2000, 2008. And I think common opinion today would say the Fed would not allow that to occur these days. Maybe the game has changed, new precedents have been set, and supportive measures would take action much quicker. I mean, they occurred quicker in 2008 than in 2000, much quicker in 2020 than in 2008. And how would you respond to that statement?
Yeah. So the question is, you got to watch the drawdown as it occurs and see what the response is. And I've said the drawdown could be anywhere from 20 to 50%. 50%. They haven't allowed a drawdown more than 50% because in the Great Depression, when the drawdown was 80%, that was a total. Anything below 50. Mathematically, it gets harder and harder to reinflate. So they stopped in 2000, they stopped it at 50. And in 2008, they stopped it at 50%. So my guess is we probably have at least maybe another 50% drawdown. And they might want that to take some of the air out of the bubble. But then they'll come in and we have to see what the response is. And then once you see the response, you know what to do.
Right. Okay. So that would be the event that Buffett is cashing up for, because when I heard you make the statement, 3% of U.S. Treasuries, exiting a lot of his positions, you mentioned Bank of America today, Apple being another. I know he's still a very large shareholder of Apple, but lessening for sure. I also wondered, like, is this partially just him getting to the end of his career, and maybe he's trying to make sure the shop is in a certain condition that somebody else could take the helm and begin their legacy, but start from a place of as risk-free, as simple, and no trades needing to be unwound, no legacy decisions left in place, sort of like a reset on the portfolio. The way I hear you talk about it is he's maybe not thinking about that. He's thinking about the next opportunity. He's cashing up, waiting for the next major drawdown to strike.
Well, if that was the case, that would have already been reported and been all over the news. So he hasn't said that. Secondly, a lot of the people that work with him, he gives them a lot of autonomy. I'm sure this is not just, his own decision. There's a lot of smart people there. And a lot of the individual stock picks have been done by some of his new favored generals. So I would say if this was just I'm preparing to hand it off, this would have been telegraphed. He knows how important it is to the markets, what he's doing. So he would have said that in one of the shareholder meetings.
Yeah. Okay. What are you watching right now, Ed, in terms of opportunity? Are you seeing anything undervalued that looks ripe? Are you placing any bets that are interesting right now? What's catching your eye?
Yeah, I don't want to get into placing bets and giving financial advice. We're trying to raise capital for a hedge fund, and people, when they ask personally, I say, look, have some dry powder, do what Warren Buffett's doing. I'm not telling you your allocation decision, whether it's 100% or 5%, but have some dry powder in cash equivalents to take advantage of the opportunities. So that's I'd be lightening up as we go higher. I wouldn't be chasing, which is what most, behavioral finance. Most people are going all in the last couple of weeks. Unfortunately, that's how it works. Yeah. That's the psychology of this. I would say what we're looking at and what we're scared about is, my team and I, we're macro alternative hedge fund, and it's quantitative based with economic fundamental inputs. And we have three indicators right now that are at major extremes: credit spreads, yield curve, and S&P volatility. And, we do long time series, and they are at values that are so off on the rubber band that when it snaps back, it's pretty extreme. We've never seen credit spreads this tight, S&P volatility this low, and with the yield curve doing what it's doing and what our economic indicators are saying. So when this, unfortunately, I don't want to be right, but when this thing does break, it could be fast, very fast.
Can you walk me through the correlation of those three?
We're going to sell it. We're going to sell it. So no.
All right. Good for you. Yeah. All right. Yeah, I'm with you. Okay. Yeah. All right. So suffice to say, though, when that elastic snaps, you hope you're not right, but it looks like you've got conviction this might occur. This will effectively trigger a margin call event, correct, leading to the correction in the market that we've been debating over the last 15 minutes. Yes?
Yes.
Okay.
Yes.
And in that event, you mentioned gold earlier, likely corrects 25%, something like that. You mentioned 50% gold correction in 2008. That's normal, but it's normal because in a margin call environment, if it's not bolted to the floor, it usually gets sold. And that's why you see everything crash all at once in a flight to cash. Yes?
Yes. Yeah. And that's why people ask me, oh, what do you think of gold here? I go, look, if you're going to buy it and put it away for a long-term investment, just know that you can buy some now, buy some in a correct. But I'm not getting into the sell all your gold to then buy it back down 25% because that's I like it long term. I just know how these things work, and gold traditionally doesn't do as well in a rate cutting cycle as it does in a rate hiking cycle. So this is and the reason why it does well in a rate hiking cycle is because there's inflation. And what people don't seem to understand is inflation did go up a ton in 21, but the rate of change, which is what people look at, has been coming down. So the rate of year-over-year rate of change. So they hiked from 0 to 5.5% in the fastest rate hiking cycle we've ever seen. All of our monetary indicators, M2, ODL, however you want to look at it, are like well below 0 year-over-year growth. And that augurs for a liquidity event at some point and a bank credit event at some point. And you got to remember there's an 18-month lag in Fed policy. So when the Fed did what they did in 2020, inflation didn't really start showing up until 18 months later, and then it took off. And in November of 2022, M2 year-over-year growth went below 0 for the first time since the Great Depression. Go forward 18 months, that was May of this year. And I would argue with you that the government's done everything they could to paper over that and keep this thing afloat. But if you try to go get some credit right now, good luck. The average Joe can't get any credit. It's hard to get business loans, bank loans. Only the big corporations are getting credit at the moment.
Right. Okay. So just to close the loop on the flight to cash scenario, Buffett going to cash, you recommending people look at dry powder, not recommending, but maybe that's what you're doing, is effectively going, skate to where the puck's going, right? You have these 3 indicators you're watching. They're all flashing red lights at you right now.
Yeah.
If you want to get into why, check out Ed's products, but the end result here is a margin call event where everything that isn't bolted to the floor gets sold because people need to cover their losses, cover their spreads. And the timing on this, I'm not going to give you a time, but it's getting closer. The higher and faster we go, the more bearish I become in price and time. When you start going like this, it's getting, you know the game. Once you start having, it's almost going to bend back on itself. Yeah. I'm more bearish now than I was 2 months ago. Yeah. Okay. Now, can you share a little bit on the history of rate hiking cycle turning to a rate cutting cycle, leading to the scenario that you're discussing right now, and how many times we've seen that in history?
I think there's been, correct me, I may have missed a couple, but of the last 20 or so recessions, 18% of them have been due to rate hike cycles. And what I mean by that is when you increase the money supply, you get increased economic activity, then you get overheated prices because inflation is a direct result of money creation. So so then the Fed takes away the punch bowl to begin a rate hiking cycle. The money supply contracts, and then a credit cycle begins where companies start to go bankrupt and money becomes dire to find and get loans, and there's a deleveraging process that occurs. And one thing we know is there were bank runs last year. I mean, these were fast, and the Fed ended the bank term funding program in March of this year. So those loans the banks were getting have been taken away. And so it's just a question of if not when we see a Fed-induced recession. And how many times have we talked about soft landings? I've been doing this a long time. I've never seen a soft landing. I didn't see one in 2000. I didn't see one in 2008. I didn't see 2020 was an average. That was a quick one. But I didn't. In my career, I've never seen a soft landing. The one caveat is I think the best soft landing was the 90s S&L crisis, where we had a recession, but it wasn't as bad as it could have been.
Okay. Why all the language then? Because I agree with you. Therefore, it's curious why that term was so popular for the last 18 months, 24 months.
It's popular because that's what the policymakers want you to believe. And if you look up soft, apparently someone put out on Twitter or X, as it's called now, a nice graph that as the number of media usage of the term soft landing increases, the closer you are getting to a recession. It was
Right.
nice. It was a nice chart.
Yeah.
Look, one of the jobs when I was on Wall Street managing BlackRock global growth portfolio of 14 billion, a CEO once said to me, "Look, my job is not to be a doom and gloomer. Even if things are getting bad, I'm still going to tell you things are great." And you take that kind of mentality and you put Jerome Powell as the face of that. They're never going to tell you because they don't want to talk. They don't want to cause a panic. So they're going to put a lipstick on a pig no matter what happens until the final truth comes around, and then they'll blame something else.
Yeah. Okay. Do you watch the commodities market much? And what's your take right now, Ed?
Well, I don't know if you've noticed, but oil is not doing particularly well, and versus inflation, oil is super cheap. So you have to ask yourself the question: is that because of the transition to EVs? Is it due to economic activity? Lumber's come down quite a bit. Copper is signaling. The only metals that are commodities that are doing well are precious metals. So the CRB has not really participated in this supposed economic financial market activity. The stocks are telling you things are great. Commodities are telling you, hold on, wait a second. So commodities are nowhere near the 2022 peak. And that's very interesting to me.
Yeah. So you would take that as a real economic indicator.
Yeah. Price is real. Price is real.
Yeah. Price is real. Commodities are truth tellers.
Yeah.
Yeah. Okay.
And metals are telling you something right now. They're telling you that there's a financial crisis coming. Gold doesn't go up just for the hell of it.
Sure.
It's the rally in gold's been relentless. And again, there'll be a correction. Don't get worried. Don't sell it. My recommendation is just buy more.
Okay. So can I press you on longer term outlook for commodities? Do you think what we're seeing, a bit of a softening, oil's cheap, lumber down, copper stumbling a little bit? Is this a sign of the direction of things to come, or is this an opportunity, or what's your take?
Well, if we do get the correction that we're going to get and the economic damage that results from it, commodities will go even lower. And so then we have to see the central bank response. And then that can do one of two things. It could unleash a commodity super cycle because of too much money, or there are other problems which I can't foresee. So, I can't predict whether we're going to be in a commodity super cycle or not until I see what the response is.
Yeah. Okay. Switching back to the White House for a minute here, Ed, we touched a little bit on, near-term American policy, whether or not a new president will be effective or not effective. We'll have to wait and see. But where the two candidates were very different, it stood out to me is on international policy and how they present the United States to our adversaries and allies on the international stage. That's where I saw a stark difference. And do you see it that way? And do you think that the new president will have a positive impact on international respect for the United States? Not so much at all. Do you think this will make an impact on America's standing on the global stage? What's your take?
Yeah, I suspect the dollar has been rallying quite a bit the last couple of months. I suspect the dollar probably figured out Trump was going to win. Because tariffs are good for the dollar, and again, tariffs are a negotiating tool. He comes in, sits down with the country, says, "I'm going to do this," and then there's a negotiation, right? He's a businessman. He's not, and if you've noticed, the dollar is getting stronger because what happens is countries that are faced with tariffs start to devalue their currency so that the net effect of the tariff is negligible. So that's why tariffs are, not terribly effective long term because people can devalue their currency. Trump knows this, but it's a negotiating tool. And I do think respect will definitely increase amongst our partners. I mean, the BRICS would never have done what they were doing under Trump, having all this open dialogue about getting off the dollar. They did it under the weakened Biden administration. I suspect the BRIC conversation kind of goes, the rhetoric goes softer, in my humble opinion. If you want that's what I think. And I think Trump is definitely going, Trump in his 4 years, whether you loved him or hate him, there were no major wars under his watch. And now, the world seems to be wanting to burn at any minute now. So hopefully he'll negotiate a peace in Ukraine, get something going in Israel, and prevent China from taking over Taiwan and Iran from doing whatever Iran wants to do.
Yeah. Okay. You know what? That's really interesting because the recent BRIC summit in Kazan in Russia, I felt like came out a bit flat, right? There was a lot of expectation and hype based on previous summits and more countries raising their hand to join and more developments on the BRIC settlement currency and all of this, but not a lot of hard announcements came out of the summit in Kazan. From my perspective, you could have a totally different take than I do, but that would align with what you just said, that maybe the writing was on the wall. There was going to be a change of administration, and that was going to pump the brakes a little bit on some of these BRICS initiatives and motivations, because BRICS isn't one organization. It's a collection. And even the core members have very different ideologies. Some want a hard break with the West. Maybe that's Russia. Maybe that's China. Some just want a bit of reform. Maybe that's India. That's Brazil. But, they're not aligned, truthfully. And so maybe seeing the tea leaves in a Trump presidency is why the BRICS summit came out a little bit like a non-starter. What do you think about that?
And the other thing that people don't realize is that when we imposed the sanctions on Russia, they fell flat. But then there was the discussion of stealing the frozen Russian assets and using that to fund the Ukraine war. That was a no-no. If you want to destroy a reserve currency, you start talking about that nonsense. So that's why the BRICS really started to squawk, because how can you have international agreements when your partners steal from you? It's never been done before. We've had sanctions with frozen assets, but we've never said, your T-bills are now ours and taken. That's theft. Yeah. And that was floated. Yellen floated it. The Secretary of State, they floated this idea. And I think the other international leaders know that Trump is not going to be that insane. And that, I think, gives them some comfort.
Now, he's come out and said he would end the war in Europe in 24 hours. I think, you hear statements like that on the campaign trail. Was it Peter Thiel? You should take Trump seriously, but not literally. So probably not 24 hours, but probably a priority is what he's saying. Do you agree with that? And that the simultaneous opinion I keep hearing is he will end the conflict in Ukraine, force them to the negotiating table, and Russia will probably have a much stronger hand at that table. But he'll probably be incredibly supportive of Israel in the Middle East. Do you have a perspective on that, Ed?
Yeah, I can't disagree with anything you said there. He'll try to negotiate a peace in the Ukraine. He came out during the campaign in support of Israel, so he'll support any kind of efforts there without compromising Israel, whatever that looks like.
Yeah. Okay. And the third almost conflict that everyone's watching is the kind of simmering tensions in the South Pacific or in Taiwan, and whether or not China will make some kind of a hostile move. I know President Xi has told his military he wants them ready for a successful takeover of Taiwan in 2027. That's not the same as saying he's going to invade. That's just, I want you ready. That's what he said. But it, has put the world on notice, and a lot of my guests that come to me from the American establishment say this is their number one priority, and what everyone's talking about at every lunch, at every dinner, is how to deal with the Taiwan-China tension. Any perspective on that conflict, Ed?
Yeah, so China is in a very precarious situation. They hit a demographic wall in 2020. My partner, Carlos Alegria, wrote a book called Economic Cycles, Debt and Demographics. And interestingly enough, 2020 was the same year as COVID. So they hit a demographic wall. They're on a decline. Their economy is a disaster right now. They have internal issues they need to deal with. And I go back to what I heard in 2002 and 3 and 4 when I was at BlackRock, our energy analysts. Energy was a big deal back when China came on the scene. Commodities took off going into the 07, 08 top, and oil was a big deal. They would come back from China saying the number one concern of the Chinese elite is their own people. And so their whole mantra was, we have to keep these people employed because there'll be revolutions, and because there's so many people. So their biggest fear is their own people. They're having an economic downturn. They have a demographic issue that's not going to correct itself anytime soon. That's causing deflation in China. And so that's rife for blaming someone else other than your own leadership. So that is something we need to be concerned about. They need to create a conflict to distract their own population. And that's why they're saber rattling about Taiwan. And this is their own tool to point the boogeyman somewhere else. So we worry about China quite a bit, that China, you want, as crazy as this sounds, you want Chinese leadership strong so that they don't buckle under the pressure of having to create a distraction for their people.
Yeah. Well, that's a good point. I mean, in the last, 200 years, there's been two very gnarly civil wars in China, which we don't talk about a lot in the West. But, around the same time that America was fighting their civil war, China was fighting theirs. And, if 6 million died in America, it was like 20 to 30 million in China. It was just a crazy conflict. And Taiwan is the result of a civil war stalemate. Chiang Kai-shek fled to Taiwan under protection from the U.S. military when the Communist Party essentially overthrew him. And for the next 50 years, it was sort of recognized as a civil war stalemate that eventually just kind of settled, but it's sort of settled unfinished. What do you think about that?
I agree wholeheartedly. People don't understand history enough. And, Warren Buffett seems to understand it. He sold all his Taiwan semiconductor stock last year. Now, he missed a good run in the stock, but again, he's not into timing. And one of the reasons he mentioned for selling it is war.
Yeah.
He actually said that. One of his risk factors.
Right. Yeah. Fascinating. I didn't know that actually. So he's exited his Taiwan semiconductor positions. He's off the island.
He's off the island. He's gone. Now, people on social media blast him because he missed a nice move in the stock because of the AI bubble. Another reason why we have such a buoyant stock market is this AI bubble, which is about to burst. Nvidia is the largest company in the world, market cap wise, which is insanity because it's a semiconductor stock, which is cyclical. Right now, as we speak, there's oversupply in AI chips. And sure as I know how cycles work, when that becomes apparent to the markets, Nvidia will be just another bubble stock like Cisco, and it'll retrace 80% of its gains over time.
You think so? Yeah,
absolutely. Look, SMCI was a number 3 customer. Their stock's down, I don't know, like 60, 70%. They didn't file their 10K. Ernst & Young fired them as auditors. So there's something weird going on in the AI chip market. And I was a tech analyst in 99, 2000, 2001 and 2. And it reminds me of the telecom equipment bubble. You had Cisco, Juniper, Lucent, Nortel. They were selling routers hand over fist. And who were they selling the routers to? It wasn't the normal telecom companies. It was the new companies that were created, the CLECs. They were all funded with junk bonds. Once the junk bonds started to wobble, there was an implosion in all the sales. What's going on in AI? There's all these AI companies being funded with private equity that don't have any revenues. No revenues. CLECs had no revenues as well. There were long distance companies that had 0 revenues. Windstar, you name it. A whole host of them that went bust. Same thing's going to happen here. And Nvidia, to make matters worse, has been investing in some of these startups, but under the condition that you buy our chips with the private equity money you raise. So we have a bunch of chips sitting around at a bunch of new AI companies that have zero revenues. How does that end? I'll tell you how it ends, badly.
I didn't know that circular trade that was occurring, that Nvidia is funding. I mean, it would make sense. They're funding a handful of AI startups using their venture capital to essentially finance their own consumer base, right,
Yeah.
to buy their products back.
Yeah, and granted, Microsoft and Google are buying AI chips, but they'll pull back on that CapEx spending once they don't have a revenue model. There's no revenue model for this AI yet. Someone point to me a revenue model, and just like what happened in the telecom equipment boom, all this bandwidth was created, and there was an overpricing in bandwidth. Pricing collapsed. A bunch of companies went bankrupt. But then that's a good thing. That created, cost-effective bandwidth for the Web 2.0 companies: Facebook, Amazon, Google. So that I look for what's going to come out of the AI bubble rubble. The AI companies that have a way of making money off this thing, we won't know for 3 to 5 years. Bubbles aren't necessarily a bad thing. They create a lot of excitement. They create oversupply and then lower pricing. It's magic.
Yeah. No, you're not wrong. You can make some money on the way up and just don't get caught. All right.
Just don't get caught on the other side.
Yeah. Okay, so I want to just, if possible, unpack the Nvidia situation a little bit, if that's possible. So, because that could be the linchpin, right? The S&P is consolidated into like 5 names, and the majority of the exchange is not moving. A very small number of companies is carrying all of the gain. Nvidia leading the pack. If something were to happen to Nvidia, that's the straw that breaks the camel's back. I mean, that's it could collapse just because of something else. But yeah, Nvidia to me is this cycle Cisco, is this where there's a lot of hope and prayers in that stock, and the way that money's managed, especially. So you have, unfortunately, most of the money is passive indexing now. So most people own, just Nvidia and a few other stocks. They don't know that, but that's what they own. I think it's something like 20 to 30% of the value of the S&P are these stocks, or something crazy like that. Yeah.
And don't quote me, but it's a very high number. And it reminds me of what happened in the dot-com boom. There was this. I used to manage my money against a benchmark, okay? And my benchmark was the index, growth index. There was growth index, value index, S&P 500. So as a growth investor, as these growth stocks became bigger and bigger weightings in your index, you had to own more and more and more until when it went the other way, it was not happy. And so it becomes a self-fulfilling prophecy. Then when it flips, it's a prophecy on the way down because you own too much. So right now, everybody that owns passive indexing, which is ETFs, and a lot of financial advisors put their people in these passive ETFs. They don't know it, but they own Nvidia, Microsoft, Apple, Google, Facebook, a couple other stocks. That's what they own.
Yeah. And so as the S&P continues to consolidate, these ETFs and passive funds continue to overbalance into those winning stocks, consolidating their exposure. In the event that turns, right, they're overly exposed to those that are going to fall the starkest because they were leading the
exactly.
Yeah.
Exactly.
Okay. That is the bet. Just to maybe close the loop on that. That is the bet that maybe Buffett's making, right? 4% of the U.S. T-bill market owns more than the Fed.
I think he's got something. I think his cash position is over $300 billion at this point.
Okay, so you could say he owns $300 billion in cash. He does, but the other way to look at that is the bet he's making is that this is unsustainable, right? That's
Correct.
What he's waiting for. He's
correct.
He's ready and waiting for that to occur. So time will tell if Buffett's right or not. How smart are you watching this video? Because he gets a lot of,
I'm happy Buffett's with me. It's been painful to be wrong for the last 12 months, but I look at it. When you go down 50%, it takes 100% to get back to break even. So that's the people forget investor math.
That's a really good point. Yeah.
And if you go up another 10% from here, but then you go down 50%, and you were hoping to make 10, and then you go down 50, that's not good.
Yeah, that's very important to recognize that $100 share price drops 50% to $50. You got to double now. You got to have 100% gain just to make that ground back. So if you're buying now, so a common I have a lot of friends that watch my show, Ed, who call me a doomer. They're like, all of your guests always calling the top, calling the fear trade, all of this stuff, and I'm with you because I have zero exposure to the broad equity market. I have exposure to a handful of like early stage companies. It's kind of my wheelhouse, mainly in the commodity sector. It's where I have a competitive advantage. And then
right. You know the space. You know the space.
What I do. Yeah, exactly.
Yeah.
Like I'm in that arena. You know what I mean?
Yeah.
Like I'm out there. And outside of that, I'm in very boring assets like real estate, gold, cash, I suppose. But it's a constant argument that I'm missing out, on this equity trade. And I guess I don't have a question off of this, but you said a few times you feel like a fool today because, this trade's been carrying over quarter after quarter. But eventually, right? Eventually, that which cannot go on forever doesn't.
Right. And also think about what happened to Michael Burry, of the Great Short fame. He was wrong for 2 years before he was phenomenally right. And his clients almost pulled all their money right before he got paid.
That's right.
And something else we haven't funded our hedge fund, but we run a model that has history back to 2000. And every year we had a positive year until the last 2 years. Our drawdown is minus 20. If you had invested 2 years ago, you'd be minus 20%. We've never had a drawdown like this. So then the question becomes, are our economic fundamental indicators now useless, or is there something else going on? And the something else that's going on is epic fraud in the government and the central bank level. And when this snaps, it's like the Big Short, but on a systemic basis. That's kind of my thesis.
Yeah. Okay. Look, Ed, I want to thank you for coming on the show today. And where can people who want to hear more from you go? Where should we point them today?
Yeah, I'm on Twitter at Dowd Edward, DOWD Edward. I post a lot there. We have a company website, Phinancetechnologies.com, spelled with a PH. And then we also have a side project that we've done on, human health, so to speak, humanitiesproject.info. Humanitiesproject.info.
Can I ask you real quick what that's all about? I actually wasn't aware of that.
Humanitiesprojects.info. We've been tracking the performance of the health of the globe, disabilities, deaths, and injuries since 2021.
Yeah. Right. Okay.
You know what I'm talking about.
Yeah. For a second there, I forgot.
But I don't want to mention it for fear of getting you censored.
I get it, man. It happens. It's a wild world, but you're right. And thank you. Okay. So I'll put links to all three right beneath this video. Once again, Ed, thanks so much for coming on the show. I really appreciate your time.
All right. Thank you so much, Jay. Good to talk.